Okay. Oh, okay. Perfect. This is this is the most important thing now. When should we take buys and when should we take sells? A very, very interesting question. I think this is where most people struggle with. Of course, we're not going to go into a lot more detail because this will take a whole day if we went in a lot more detail. So technically speaking, this question is very important, obviously. Ideally, the buy orders are supposed to be taken at a logical support area with the anticipation that price should continue bullish. Make sense? Right? When you're looking for buys, your buy orders are placed where you think price is going to go bullish, where you think price is going to continue bullish. And what's the best point in the chart where price goes bullish from? That's the support. You're always looking at the support because price will only go bullish from a support, right? You have a support. Oh, wrong color. Let's get a better color. Let's say you have a support and candles are closing bullish. Candles are closing bullish. Now, what do you do before you take entries? What do you do before you take entries? Right? Before you take entries, you need to identify where is going to be your stop loss. Yeah, exactly. Right? Your stop loss. So when you have a candle closing bullish at a support, your stop has to be below that support, or your stop has to be below that candle. Let's say if it's a 1 hour candle or a 4 hour candle, ideally your stop is going to be below that candle because now you're anticipating for the next candles to continue moving bullish, right? So when your stop is placed here, you've identified your stop loss, because what most people do is you don't identify your stop. Most people take a trade and then they say, okay, you know what? I've taken a trade right now. So what I'm going to do is I'm just going to be in this trade. And when someone asks, oh, where's your stop loss? Most of the times they say, oh, yeah, man, I have a mental stop loss, and mental stop losses don't work. They don't work. Mental stop losses, they just don't work, because when price moves very fast against you, it's just going to move against you and mental stops aren't going to work. So what you got to do is whenever you're trying to take a trade, you need to identify where your stop is going to be. So let's say, hypothetically speaking, that you have a 1 hour candle closing bullish, your stop is going to be below that candle. Because if you're saying that we're at support, price is formed bullish and price should go up, right? Or you're saying that, okay, price should make higher highs and higher lows. What you're going to do is that you're going to place a stop below that candle because now you're anticipating for the next candle to continue bullish like this, and your stop being safe right over there. Now, obviously, this is not going to happen all the time. This is not going to happen all the time because, there's always a probability, and the probability is there's a 70 to 80% probability that once you have a high time frame candle closing bullish, there's a higher chance for the next candle to also go bullish. If for some reason price goes bearish and hits your stop, your trade is nullified. That's the idea, right? Now you're no longer in the trade. Now your trade idea is gonzo. It's finished. Your trade idea is gone. That's it. So that's when you have to understand that, okay, you took a trade, you planned your trade, you waited for price to come down to support, and then you waited for a candle to close bullish like a good boy. You opened a buy, you placed your stop below the candle, you anticipated candles to make higher highs and higher lows, but for some reason, price came down and stopped you out. And that was your trade. That's a probability. This happens to me all the time in the live streams. We take a trade and candle comes down and stops me out. And now I'm like, okay, well, that was a trade. That was a probability. That's the risk you're trying to take. Now, this will happen most of the time. Most of the time, candles will go your way. But those small amount of times when candles go against you and stop you out, that's when you have to step back and you have to understand that, okay, why? What should I do now? Should I just accept it as a probability of a loss, or was there something you missed? Right? So that's what we're going to talk about later on. But taking positions, when you're looking to take buys, you're looking to take buys at supports, or when candles are closing in your direction. That's when you're looking to take buys. In the same way, if there's a bullish candle on the 1 hour and the 4 hour time frame, then there's a higher chance that the lower time frame will continue bullish. That goes same for the 4-hour, daily, and the weekly. You know, for all you swing traders out there, this happens on the 4-hour, daily, and the weekly as well. You know, but here's the thing. Why is your stop being placed below the bullish candle? You know, why? Why are we doing that? So let's take a look at that. So now actually, let's take a look at the more opposite context of this idea. Now, look, you must wait for a 30-minute candle or the 1 hour to flip bullish first. Even Raja said this here. You must wait for a 30-minute or 1 hour candle to flip bullish first. You need to wait for the candles to close in your direction before taking the trade. Right? So let's say you have a resistance. You have a resistance, and then you have a bearish candle forming at resistance. Right? And now you have a stop above that candle, and you're anticipating the next candle to continue bearish. Right? So when you have a downtrend, price makes a low, price comes up, creates a resistance, and then price creates another low right over here, right? So now, technically speaking, price has to retest here and continue moving down. But what if price goes up? Right? If price takes out the previous high, then your downtrend is no longer valid. That's very important. In the same way, when we're looking at this candle here that's closed bearish on resistance, what we're trying to do is now we're trying to say that, okay, the next candle should continue going bearish, right? But instead, what happens is that what if the next candle goes bullish and it breaks the high of the previous candle? You know, if it breaks the high of the previous candle. If the candle breaks the high of the previous candle, then this sell is no longer valid. And if you have a mental stop loss, and if the 1 hour candle has broken the high of the previous candle, oh boy, oh boy, oh boy, you might be in for a rude awakening. You know, if this has happened to you, if you have had a mental stop and price has gone against you more than you expected, say I. I'm going to say I right over there because this has happened to me too. Yeah, I'm going to say I don't want to shy about it because this happens to everybody. You know, that's why you don't have mental stop losses. Because mental stop losses, they're not going to work. You have to have a solid trade setup. You have to plan your trade. If you're looking for buys, you're placing stops below the high time frame candles, like the 1 hour or the 4 hour candles. If you're looking for sells, you're placing stops above the 1 hour or the 4 hour candles because you're anticipating price to go in a downtrend, you know, to make lower highs and lower lows. If you're taking buys, you're anticipating price to go in an uptrend for making higher highs and higher lows. Oh, a bunch of people said I's in YouTube. Only one person said I in Zoom. So I think everyone's okay in Zoom. We got professionals in Zoom here. All right. Let's go to the next one here. Okay. So we got here. Higher the time frame, the stronger the confirmation. Again, you know, when you're looking at the small time frames, the small time frames are going to have weak confirmations. They're going to be very, very weak confirmations. When you have the higher time frame, the higher time frames are going to have very, very strong confirmations. It's very, very important, you know, that you always look at the higher time frame and where the candles are closing. Same thing goes for sells. They're supposed to be taken at logical resistance areas with the anticipation that price should go bearish. Make sense? That price should go bearish. So when we're looking at candles again, now during this webinar, I will be going through, during this webinar, we're going to be going through one concept over and over again. And that's the concept when price is making a low, it makes a low right over here. You know, let's say it's making a low. Then it's going to create a support. It's going to have a little pullback. I'm always bad at drawing bullish candles. It's going to have a little bit of a pullback like this. And then you have to wait for candles to close in your direction because there's a very high chance that price will retest that low it created down over here. You know, that's the trade we try to take. That's when you say that, okay, you know what? I really understand how market is moving. I really understand what candles are doing in zones. I understand what candles mean when they're creating higher highs or higher lows. That's very, very important. Right. So let's go to the next thing here. Let's see what Raja got in store for us. Oh, bearish candles forming on a 1 hour 30-minute are nice intraday confirms. Yeah, see, now back again. Now, when you're looking at, let's say, the pre-New York, you're looking at pre-New York prices that support, and you have a 1 hour candle closing bullish, or when you have a 30-minute candle closing bullish at support, then you can say that, okay, well, if these candles are closing bullish, there's a higher chance that the next candle is going to continue bullish as long as it respects the low of the previous candle. That's an uptrend. In uptrend, we're making higher highs and we're making higher lows, and then candles have to respect those higher highs and higher lows. So we're cool now? We good so far? We only talked about higher highs. We only talked about higher lows. And then we talked about entries. That's it. That's all we talked about. All right. So, what about a stop loss? Yeah, we also talked about a stop loss here too a little bit. First, we have to define what is a stop loss. What exactly is a stop loss? Some people say, oh, you know what? Like stop loss, yeah, tap out point. Someone said stop loss is a tap out point. So when candles move against you, you're tapping out. You're like, okay, you know what? This is it. We got to get up. We got to get out. Eject. And that's when you close the trade. Now, you must have seen on the live streams, I close the trades all the time because, when price breaks the low of the previous candle, if I'm in buys, or when price breaks the high of the previous candle, when I'm in sells, I most tend to, I close the trade. I'm like, okay, you know what? Price is not doing what I expected it to do. So it's better for me to close the trade. So I close the trade. A stop loss is an area in the chart which, when broken, nullifies our trade. That's a stop loss, right? That's basically a line on the chart that you place that once price reaches that line, or once price breaks a high in a sell, or once price breaks a low in a buy, your trade is nullified. That's what a stop loss is. That's basically it. Now, where are stops placed? Before we talk about that, let's go back to trends that we talked about, right? What were the trends we talked about? We talked about the trends, right? We talked about the uptrend, which goes up, makes a low, and tries to go up. So when the uptrend is making a low, you're placing your stops down over here. Make sense? You're placing your stops down over here. And then you're placing your stops down over here, below the lows. Right? And then you have, when price comes back down to make another low and goes up, now you're placing your stops down over here. Right? This is market structure, and this market structure on candles, it kind of looks like this. Like you have candles going up, and then you have candles coming down, and then you have candles that go back up again. And then they come down again like this. Some stupid drawing over here. I don't even know if this is the correct uptrend. There we go, candles coming down, and the candles going back up again, right? So this is an uptrend. So let's say this is on the 5-minute chart, right? If this is on the 5-minute chart, what would the 1 hour or the 30-minute chart look like? A 1 hour or 30-minute chart might look like something like this. This is what it might look like. Candles are making higher highs and candles are making higher lows. So when you're taking buys, you're putting your stops below the lows right over here, which is also right over here. And your entire trust is in the fact that, okay, since price is going to go up, it has to make higher highs and higher lows. That's all the trust you're putting into. Price should continue up. If it's going to go up, it has to make a higher high and a higher low, and that's going to be your trade. That's all going to be your trade. That's it. So this is the trend. And the same goes for when we're looking at the smaller time frames. Let me just remove all this here, this jargon. Actually, let's see what's on the next agenda here. Because on the bearish trend, it's kind of going to look like the same. Okay, so candle trends are most important, right? The higher the time frame, the stronger the trend. I've probably repeated this a lot. This means high chance for candles to make higher highs, higher lows, or lower lows and lower highs. We're only going to talk about lower highs, lower lows, and higher highs and higher lows. That's it. That's all we're going to talk about, because that's the way the price trends. And what do they say about the trend? The trend is your friend, so that's all we're going to talk about. So when price is moving bearish, it's making a low, it makes a lower high, it makes a lower low, it makes a lower high, and it makes another lower low. So when you're looking at this from a candle's perspective, you have candles coming down, and then you have candles that kind of go up, and then you have candles that continue to go down, and then you have candles that go up again, and then you have candles that continue to go down, right? So that's your downtrend. But what will this look like on the 30-minute and a 1-hour time frame? Probably going to look like this. You have clean candles that are making higher highs and higher lows. Oh, lower highs and lower lows. And you're placing stops above the highs, because unless this high is not broken, you're still in a trade. At the same time, when you look at the candles, make a high, make a lower low, make a lower low, lower high, lower low. That's it. And you're placing stops above the highs, because if for some reason the next candle breaks the high of the previous one, then the chances for candles to continue down, they get lower. And if it's in downtrend, that maybe this is the low formed right over here. So then what you got to do is you have to wait for candle to maybe close in your direction first, so that the low which created here could be retested again. Right? So stops are placed above resistances. But if you don't understand resistances, stops are placed above, let's say, a higher time frame candle. Maybe let it be a 4-hour or even a 1-hour or even a 30-minute time frame. 30 minutes is still aggressive, but still works. 1 hour is perfect. 4-hour is beautiful. But the higher the time frame, the higher the stop loss, so you really got to understand what your risk would be in that aspect. A safe placement of stop is below the 4-hour candle or a 1-hour candle in an uptrend. See right here, it says right here. And above a 4-hour or a 1-hour in a downtrend. That's a safe spot. Because if those highs are broken, then there's a very high chance price is not going to continue going where you want it to go. That's just as simple as that. Oh. Okay. What about take profits? Where would you put the take profits? The take profits should be placed in logical areas. Now what most people do is now, let's say you have a resistance and you have a support, right? You have a resistance and you have a support, and you have a candle that's closing bearish here, right? Closing bearish here, and someone's going to get the idea that, okay, since this candle is closing bearish, and now we have confirmation that, okay, the next candle should continue moving bearish. So what I'm going to do is probably going to put a stop above this candle and anticipate the next candle to continue bearish as long as it respects the high of the previous candle. As long as it respects the high of the previous candle. And then what they're going to say is that, okay, my take profit is going to be 1 to 3. So 1:3, like say 1:3. My take profit is going to be 1:3. All right, so that's your take profit right there. 1:3, and you're going to take profit down over here. Perfect. Seems about right. Risk reward is there. But what doesn't make sense is now you're expecting price to break the support when the support hasn't broken yet. That's what you're trying to do. Because this support has to break before price comes down to your take profit. So your take profit has to be a very logical take profit. Either you can take a position up over here with a stop loss above this candle and then just hold it for price to anticipate to break the support, or you can actually wait for price to break support and then look to see if you can head over down all the way down to where you want it to go. Because a lot of times, people have take profits beyond some very important zones. And I always say, man, why? Why do you have a take profit above an important zone when price hasn't broken that zone? Doesn't make any sense, because you have to identify what's the safe target for you to secure positions. So what we're going to do now is we're going to go to the next slide here, and we're going to see what's in store for us. You need to understand the difference between a logical take profit and a stupid take profit. See, so that's what we talked about. We talked about the logical take profit. You know, it's going to be a logical take profit in a uptrend is going to be at a resistance, right? That's going to be logical take profit. It's going to be at a resistance. A stupid take profit is going to be above resistance, right? But if you're looking for, let's say, sells, a logical take profit for sells is going to be at a support. You know, a stupid take profit in sells is going to be below a support when we don't know it's going to break. You know, like people send me charts all the time that, hey, you know what? My take profit is below that support. Fuck yeah, we're going to get it. How do we know? How do we know we're going to get there? We don't know unless we get there. You know, a logical take profit is placed at, oh yeah, see, it says right over here. A logical take profit is placed at 4-hour, 1-hour zones or support resistances. You know, support resistances, right? How do we find these zones? Well, we have to do some chart work, right? So how do we know where to put a take profit? How do we know that? You know, we have to do some chart work. We have to look at the chart and we have to see that, okay, what take profit makes sense, right? So what we're going to do is, oh, no examples? Okay. All right. So step one is to identify the most recent support resistance. That's step one. The most recent support resistance. Once you have that laid out, the step two is to identify the next support resistance or an area where price is more likely to move to. You know, this makes sense so far. I think it makes sense so far to me that to know where to put take profits is to know where price might head to. And that's going to be the next support or resistance. And that's where your take profit is going to be. It's not going to be beyond those areas because then there's going to be a stupid take profit and then someone's going to roast you. All right. Let's look at some examples. Perfect. So we're going to look at some examples here. Oh. This is not the right one. This is the right one. Rakil, could you share your slides later? No. I'm sharing this webinar. It's good enough. Okay, perfect. So now, since price is heading down, what's this? 121, this is EJ. Okay, since price is heading down, this is the daily chart, right? So we're going to do some chart work right over here. All right, so price is heading down. This candle is bearish. So where does price head down from? Resistance, right? Price heads down from some sort of a resistance. So when this daily candle is forming bearish, right, and when we look left, there's a clean candle. What are the chances that price is going to come down to this area right here? Let's say 12900. I say there's a higher chance for price to come down to 12900 rather than going up. Because the only reason price is going to go up is if we have a bullish candle forming right over here. If we have a bullish candle forming right over here, that's going to be the reason that price is going to go up. Oh, we're having some technical difficulties here. Let me just fix this technical issue. Okay. Yeah, I guess you just gotta refresh it here. Okay, perfect, right? The only reason price is gonna go bullish is when you have a candle, forming bullish. You know, but right now the candles is bearish, so we're looking at bearish confirmation. So when price goes bearish, we're looking to see, okay, which area price is gonna go off to. So we look left, we're like, okay, looking left, we have candle going bullish, bullish. So maybe this is a good area right over here. So that could be your take profit. That's it. That could be your take profit. So if you're trading this based on the daily time frame, maybe you could turn around and say, okay, yeah, you know what? I'm just going to put a stop over here and anticipate price to, you know, maybe fill this wick and then eventually come down to this area. But what if someone says, no, man, my take profit is down over here? Now that's going to be a stupid take profit. Well, I'm not going to say stupid. That's a strong word in the snowflakes generation. I'm just going to call that this is a very aggressive take profit. So this is going to be your safe take profit, and this down here would be your aggressive take profit. So you always got to put yourself in the best position to win. And the best position to win is going to be candle is bearish. If candles are bearish, there's a higher chance price can continue moving down to the support. That's it. That's your whole analysis, and then you can slap on indicators here and say, oh yeah, the EMA is this and divergence is this and RSI is this and ADR is this and fucking Bollinger Band is doing this dirty dance and it should continue down. You can do all that. But by just looking at the candles, what you see is that candle is bearish. You can have a stop above the bearish candle because, hey, if price is going to go up, the next candle is probably going to break the high and then it's going to start moving up. Right? Perfect. Very easy example. Take profits, looking at take profits, and that's all what we're doing. All right. Oh, what's this? Gold. Good old gold. Gold is moving bullish. Gold is moving bullish. Right. So now when gold is moving bullish, so sometimes, what's going to happen is that sometimes price is not going to do a retest. Price is not going to do retest and things are just going to happen here, there. You're like, oh yeah, whatever. So now, what's step one? Step one is going to be, you're going to look at the most recent support and resistance. So when price is moving bullish, you need to look at, okay, where is price going bullish from? That's what you got to look at. So price is going bullish from a support. And that support is probably going to be down over here. We have a support down over here, right? Now, but when you look left, you're looking left, right? You're looking left, there's a clean candle. You're looking left, clean candle. You're looking left, you're like, oh, uh-oh, there might be some sort of a resistance over here. So then now you're going to say, okay, then maybe instead of having this support down over here, we might have some issues over here. 1492. Right? 1492. That's just step one. Step one is identify the most recent support. If price is going bullish, you need to identify the most recent support. And when price is going bullish, it's probably going to go to the next resistance, right? So where's the next resistance? Probably going to be somewhere over here. 1508. That's going to be your next resistance, right? The reason 1508 and not up over here, 1516 is very, what you call it, is aggressive. I would say 1516 would be aggressive, but when you're looking at areas, you're looking at probably this area over here. Now you have a take profit, but having a take profit, let's say up over here at 1524, that's going to be a stupid take profit. That's not going to work. That's going to be stupid take profit. But can you take a buy right over here or not? You can't. You can't take a buy because price is moving bullish. You need to go to the small time frames. You need to see if the support is going to be formed. But now someone would say, oh yeah, he just looked at the daily time frame and he didn't look at the small time frame. Well, I have an answer for everything. This is a small, this is a smaller time frame. This is a smaller time frame. So in the small time frame, you see we're creating a resistance and we're creating a support, right? Now look at this. We are at, this might seem small. This is not small, man. This is a 1498. And then we have 1550. And this is almost like the 25 to 30 pip range. This is a 25 to 30 pip range. And when price moved bullish, where did price move bullish from? Price probably moved bullish from down over here. This is where price moved bullish from, right? So when we're looking for buys on gold, realistically speaking, you would want to see a little bit of a downward move and then a support being formed. Either support should be formed somewhere over here or support should be formed somewhere over here. Because once that support is formed, what's going to happen? Right? Once that support is formed, let's say the next candle comes down over here, and then you have some sort of a support formed over here, and then you can say, okay, perfect, we're in an uptrend. I'm looking at the 1 hour chart. Candle has closed bullish. I might want to have a stop loss below this candle, anticipating a further move up because, like gold is going up. On the daily time frame, we have a target at 1508, so it just makes sense. It just makes sense that on the daily time frame, if the target is 1508, on the 1 hour time frame, you want to see some sort of a support form. Because that's what we talked about in the last, 11 slides, that when price is in an uptrend, you need to wait for support to be formed for price to create higher highs and higher lows. And where is your stop is going to be in this scenario? Your stop is going to be below this candle, because let's say, for example, that you had an early entry, right? Let's say candle closed bullish and you took a buy, you placed a stop down over here, and this was an early entry. And what the next candle does, the next candle just, it makes a wick up over here and it comes down and slams through your stop loss. If the next candle slams through your stop loss, what are you going to do if you get stopped out? What do you do if you get stopped out? Do you try to take a sell? Because now you're going to be like, okay, next candle is going to go down. Are you going to take a sell, or are you going to say, okay, you know what, I'm just going to relax and be patient? Someone said we're going to walk away from the charts. That's perfect. You got to relax. You got to chill out. When you get stopped out, you need to just relax. You need to see that, okay, you know what, I'm just going to wait a little bit more, because even if it's an uptrend, this might be a little pullback, because gold does those pullbacks, and you're just going to wait. You're going to wait to see if there's another support form down over here, and you're going to look for the same confirmation. It's a bullish candle, because if you get a bullish candle on the 1 hour or the 30 minute, there's a high chance that the uptrend is going to continue. Same thing we had over here, candle closed bullish, then you can say, okay, a support is formed, and the next candle went bullish, it filled this wick, and if you had a runner, that runner kept on going bullish. Now when we look at that, okay, now when price was going bullish, and we got to keep stops small and whatnot, and then you're like, okay, this candle closed bullish, and your stop was below this candle. You took a buy when this candle started. Now, when this candle has closed bearish, what are you doing? What are you doing when that candle closes bearish? When you're in a buy and the candle you got in closed bearish, what I like to do, I like to close half of my position, because I wanted that candle to go bullish, but it closed bearish. Now I gotta decide that, okay, if this candle closed bearish, there's a high chance that the next candle is going to go bearish, but there's also a chance the next candle can go up. We don't know that, right? We only go based on what the candles tell us. So if this candle is closing bearish, I'm taking half of my positions off, because now I don't want to risk losing my complete stop loss. I'd rather lose 50%, or, if there's a chance for the next candle to go up, man, I actually want to catch that move too. So I'm going to close half of the positions, right? Same thing goes when price is going bearish. If you're in a sell and you see a candle closing bullish, then on the 1 hour time frame or on the 30-minute time frame, then, maybe that's that's a chance for you to maybe take half off. So we have a question here. So you can close 0.5 lot of a 1 lot in negative. Yes, you can. Yes, you can. All right. This should happen all the time, right? This is a question. The question is that, okay, these concepts, they seem very simple, but should these concepts happen all the time? This is the question. There's always a probability, of these things happening. There's always a probability. There's a probability of this happening. There's a high chance it might happen, but then there's also a chance it might not happen. These are things you really need to keep in mind. If a 1 hour candle closes bullish, there's a very high chance the next candle will also go bullish. There's a very high chance, that will also go bullish. But, what if the candle does not go bearish? Then that's just a probability. That's just a probability of it not happening. That's it. This should be happening at support. Same goes for resistance, right? So if you have a 1 hour candle closing bullish at a support, there's a higher chance that the next candle will also go bullish from a support. There's a very, very high chance. In the same aspect, if you have a bearish candle closing at resistance on the 1 hour or 30 minute, there's a high chance that the next candle will also go bearish. That's it. And if you're placing stops above the candles if you're taking sells, and you're putting stops below the candles if you're taking buys. That's basically the most simple way to put trading in candles, like how candles move. I mean, trading is just all about candles, how candles move, how candles react to zones, how candles react when they have a bullish candle or, they have a big bearish candle, like all those things